I hope you guys are ready because this month coming up, January of 2023, it's going to be a massive month for the stock market. And in this video, we're going to go over exactly how January has performed historically, let's say over the past, I think the data that we're going to go over is 70 years, maybe 50, actually 75 years. Yeah, we're going to talk about the past 75 years of data here for January, and we're going to go over just in general stocks that I'm looking at, mostly big tech here, as a lot of big tech companies are reporting earnings in January. So we have a lot to break down, and on top of that, we're going to talk about the Dow Jones, how it's only down 10%, and how that index has done throughout the previous bear market. So if you all find value, hit the like button, subscribe. That's all I ask. And let's just dive right into the video, guys. Let's not waste any time. So right now, we all know at this point in time, it's the end of 2022 and I'm filming this video. We're about to get into 2023. We all know the stock market has been a disaster throughout the course of this year. SPY, which tracks the S&P 500, started off the year at 480 and now it's at 380. It's lost about roughly $100 per share, which in terms of percentage value, that is roughly 20%. So SPY just this year has gotten into a bear market. We have Triple Q, which tracks the NASDAQ 100. Last I checked, this was down 35% from all-time highs. Let me see here. From 408 to 266, it is down 35% roughly. So yeah, well into a bear market here for Triple Q. And if I pull up the Russell, let me show you guys the Russell. This thing is down roughly, I think 30, 35, right? More like 30%, 28%. So it's down. It's in a bear market, just like the other indexes. And the Dow Jones, which is pretty interesting here, is not down much at all. Really, it's only down 10%. Not even, it's barely in correction territory, guys. You know, I don't know if you know this, but if a stock falls 10% from its all-time high, that's what constitutes correction territory. But if it falls 20% from, it doesn't even have to be an all-time high. If it falls 20% from any recent high, that's what constitutes a bear market. So this is not, it's barely in correction territory, and we'll talk more about the Dow later in the video. We'll wrap back around, and talk about it. But first, now that we just covered very briefly how the stock market has done throughout the year, let's dive into here how the stock market has done historically in January, because we've seen throughout the course, of history, certain months are better than others, right? There's certain months that are awful, like I believe September is a bad month for the stock market. April is a pretty good month for the stock market. So let's see how January has done historically, and we'll talk about some other things here. So make sure you guys stick on throughout the video. So January, and this, by the way, is moneychimp.com. No, they're not sponsoring the video, but, I got to give props to them because I've used this website before, showing you guys this data, and I'm using it right now. I love the way they have it laid out here. So this pretty much shows how the S&P, essentially it shows, the S&P 500 over the course of the past 70 or so years, broken down by month. And, it shows the up years, the down years, how the S&P 500 performed during those months, during the certain months, during the certain years. So if we click January here, which I've clicked right now, we can see 43 up years, for the month of January. So out of, this 72 years, 43 of them were up years for January. 29 of them were down years, as you guys can see right here. And the average return is roughly 0.94%. And of course, there's some months that are, some years that it was bad. January was rough. Some years were better, like with every single month here. But overall, January is a pretty decent month for the stock market historically. Not bad. Average return of 0.9%. And if we scroll over here throughout the up years, we can see the recent up years. 2020, we had a 0.6% green month for January. 2019, we had a big move, which we'll talk about in a second. In 2018, 17, pretty much all the years throughout the bull market for the most part, except for, wow, look, between 2014, 15, and 16, that 3-year stretch, it looks like January lost every single year. You guys can see here, January lost 3.4% in 2014, 3.1% in 2015, 4.8 in 2016. And if you guys remember December of 2018, little history lesson here. Do you guys remember what happened? We had a pretty big crash heading into the end of the year. That's when the Fed tried raising rates. If you guys don't remember that, I think didn't we get up to like 2.5% at that point? It was, the end of 2018. And yeah, the stock market did not like that. You can see here, this is is this the biggest down year ever? It might have been. Yeah, no joke. The biggest down year ever for December was in 2018, which is nuts. It had a 10%, the biggest down month rather of December was in 2018. 10% is what it lost in December. And if you guys remember, as we got into 2019, they pretty much did a U-turn on the interest rates. They dropped them slowly back to zero from that point. Obviously, they got to zero in 2020, and you can see in January of 2019, we had a ridiculous bounce back month. So remember, like I said, in December, we lost 10% in 2018, and then the following month, January of 19, we rebounded 9%. Unbelievable, and I believe we obviously went a lot higher from that point. Then the bubble of 2020, 2021 came, and here we are today, 2022, as we're getting into 2023. So, of course, we can't just base this data off of, or we can't just base or bet for sure and be 100% right that, because there's more up years and down years in January, 2023 January is guaranteed to be a green year. That's not real, or a green month. That's not reality. But there's more up than down years in January, just saying. And the average return is 0.9%. Do with that information with what you will. And of course, one key difference between now and where we were in 2018 heading into 2019. Remember, like I said, the Fed tried cranking up rates. Markets didn't like it. They reversed that very quickly. And what are they doing now? They're still cranking up rates. So just because, in 2018-19, we saw that huge reversal heading into January after our awful December, that doesn't mean it's going to happen again. Because back then, we had rates at 2.5%, and they slowly started going back to zero. Now rates are at what? Over 4%, and they're not slowly going back to zero. They're actually continuing to go up, and we're probably going to see those, who knows, maybe go to 5%, over 5%. So it's a very different scenario right now. So don't just 100% expect a huge bounce back month in January. It's possible, but realize the setup right now is way different than what it was in 2018 heading into 2019. So what do you guys think about that? Let me know your thoughts down below in the comments as always. And now let's transition back over to ThinkOrSwim and quickly run through. Oops, I don't want to move that. I do not want to move that. We have to move my face a little bit here, guys. Let's run through quickly the Dow and some big tech stocks that I'm looking at as we're getting into this new year, because finally it seems like it has been pretty boring on the earnings side, in terms of big companies reporting. But in January, more towards the end of January, that is going to be changing. We have big tech names, including Apple reporting. Let me pull this up, guys. Apple is reporting, which you guys can see. Apple has slowly been selling off. I mean, well, not really slowly. Well, I guess it's happened over the course of a couple months, but it's down 25% from the recent 175 high that was hit in the middle of August, and they report earnings on the 26th of the new January of the new year here, guys, which on that day, they're looking to report, and these are all estimates we're going to talk about, $1.98 in EPS on revenue of $122.7 billion, which would be down 1% year over year. So big tech, it's coming up. And if you guys didn't know, Apple hit a new low. I believe, was this today? No, that was yesterday, right before the closing bell. We hit $125, which is not good considering the lows from a couple months ago were right around 129, 130. So Apple took those lows out. So we'll see how these earnings come out, guys. It's going to be a big month. Amazon, we also have them. I don't think they've officially announced their earnings day. Maybe it's early February. I was trying to find it when I was prepping this video. I couldn't find it. But Amazon is trading at a pretty low price point. Now, does that mean it's cheap? I don't think it's cheap yet as a stock, but the price, if we're just looking at the dollar value, it has come down a lot from $190 now to $85. And if we pull up the max chart, we're now pretty much getting to the levels that we haven't been at in about a couple years. 2018, 19, right around, 80-ish dollars a share. If we start breaking under, 70, 75, 65, guys, Amazon's going to be at multi-year lows, which is going to be interesting. So they're looking to do 19 cents EPS on revenue of $145 billion, which would be up 5.9% year over year. Not bad. Now, Meta, which I believe out of all of these big tech names, I'm still sticking to this, and I've been saying this for a while, even though I might get some flack for it. I think if we're just looking at the numbers, it is the cheapest one out of all of them. This and Google, I'd say. I love Google. It's my favorite individual stock. But just looking at both of them, I have to say Meta's cheaper than Google, no doubt. And they're if I had to buy two, and I mean I have been buying these to be honest, guys. But out of the 5 big tech names, these are the 2 that I'm buying, Google and Meta. I haven't really bought much recently, but throughout the bear market, these are the 2 that I've been focusing on. And Meta, I've been picking up. Last I bought, I think it was under $100. Now it's rebounded a good amount, so I'm not looking to rush any more buys yet. But this is one that is reporting at the end of January. They're looking to do EPS of 221 on revenue of 76 point, or that's actually Google. Let me see. Meta is 31 billion, which would be down about 6.5% year over year. So look for Meta's revenue to be down year over year. Now going to Google, which I almost pretty much just spilled the beans on that one, guys. Revenue 76.7 billion is what the estimate is, which would be up 1.8% year over year on EPS of $1.20. And you guys can see here, Google is down from 150 to now 89. Well, today it's up 3.5%. I wish it was down 3.5% because I want to buy it under $80 a share, guys. But today it's up 3%, and overall it is down from 150 to where it is now, roughly 90. That is a down move of 40%. That is a pretty big move there, guys. But overall, Google is, one of my favorite stock. Well, it is my favorite individual. It's my biggest individual stock holding. I have a lot of companies that I like. I said this yesterday, guys. But it's definitely one of the best companies out there, no doubt about it. And if it comes under 70, well, especially 70, but if it comes under 80, under the 70 mark, I'm going to be buying a ton more Google. So Microsoft, last big tech name here, they're looking to do EPS of 229 on revenue of 76.7 billion, up 1 point. Oh my God, I keep reading the wrong line. Revenue of 53 billion, up to 2.4% year over year for Microsoft. So it looks like barely any of these big tech names are going to be growing much at all year over year. In fact, a lot of them are going to be down or pretty flat year over year, which, to be honest, is expected. And Microsoft is another one of those barely growing revenue, pretty much flat year over year. So keep your eyes on those 5 names. And of course, we're going to go over them a bunch more in January. So make sure to subscribe to the channel. Yes, you watching, if you haven't done so already, make sure to subscribe. And now before we wrap up this video and just end off the video, let's look at the Dow, because this is alarming. This honestly makes me believe that the bear market could be far from over. I'm not trying to be a doomsdayer, but the Dow freaking Jones, guys, like I mentioned in the beginning of the video, NASDAQ's down 35%, Russell 30%, S&P down 20%, Dow's only down 10%. I mean, that is nothing. If we look at previous bear markets, previous crashes, recessions, the Dow Jones has come down well over 10%, well over 10%. In 2007, which this crash began in the end of 2007, as we, creeped into 2008, and it got very deep by the beginning of 2009. It was really bad at that point. The Dow Jones went from 14.2, right at the, all-time high back then in 07, 14.2, all the way down to about 6,500, which is a drop of 55%. And let me say this again. Right now, the Dow Jones is only down 10%. Keep that in mind. We dropped 5.5 times more back in the 08 crash. And if we go back even more, let's take a look at the 99 '99 debacle here, 2000. We can see the Dow is at about 11.5 at the all-time high back in 2000, roughly, right? End of '99. It was at about 11 whatever, 11.7. Then it came down to about 7,200. Not as bad for the Dow, of course. That was when the tech bubble busted. A lot of, the NASDAQ got annihilated. We're not going to get into that in this video, but even back then when the Dow didn't do that bad, it still went down 38, 40%. Still down a lot more from where it is right now. And I've mentioned this before, guys. We've talked about these Dow stocks all year. They've been on fire. Pretty much all of them. Sure, there's a couple that haven't done well, like Disney, what else? Nike, I guess, hasn't really done that well. But a lot of these have done very well. A lot of the Dow stocks have crushed it, and a lot of them at this point are just flat out overvalued. We're not going to get into all those in this video because already we're kind of long in this video, but just realize a lot of the Dow stocks are overvalued. Dow's only down 10%. If this bear market recession really gets ugly, I'm not trying to be a doomsdayer, but man, the Dow's got more downside, which means, let's say the Dow goes down. I said this a couple days ago. If the Dow goes down, let's say 30%, 35%, maybe it's not that bad for the Dow like it was in 2000 and only went down 38%, only went down. Let's say it goes down 30% this time around. That means the NASDAQ's probably going to go down another 15, 20. Maybe the S&P goes down another 20, 25. NASDAQ actually 15, 20, probably more like 30, 35. The NASDAQ could go down maybe overall 60, 65% or something crazy. So, yeah, I'm just saying, the Dow is holding up way too well right now for this to be a nasty recession bear market. And quite frankly, we're not really in a nasty recession bear market yet, which makes me a bit nervous heading into this year, as we are seeing layoffs, unemployment could start to shoot up. Of course, inflation's still there. Economy could get worse. I don't know, guys. We shall see. So what do you think? Let me know your thoughts in the comments. If you enjoyed the video, all I ask is to hit that like button, subscribe, and if you want some free money, well, I guess there's more to ask. If you guys want some free money, use those links down below. You can get up to 20 stocks from Moomoo and 12 stocks from Webull. And if you want to check out the Patreon, also linked down below. And with that being said, I'll catch you guys in the next video, which I'll pop one up right here. I'll see you there. Peace out.